Greetings from Pristine. My name is Ankur Kulsresht, welcoming all viewers to the session on investor needs and investment policy. Before getting on to the concepts in detail, let's look at the list that we need to cover in the forthcoming slides. We are going to start with the importance of identifying different investors and their different needs. Now, what I mean by needs is the different characteristics which define a particular investor. The characteristics in terms of the time requirement, the liquidity challenges, the taxes, the regulatory aspects, the return requirement, the risk capability and willingness, etc., etc. While we do this, we are going to make a contrast, or should I say make a comparison of different types of investors, and we will also come and kind of discuss the need of giving out a suitable investment product to each of these. Then we are also going to talk about what is investment policy statement, which is really the charter of the document, the rules, the regulations between the fund manager and the investor. So it's also one of the very critical areas to understand. So this is going to be like a 30 to 35 minute recording, which we are going to, like I said, going to cover the types and characteristics of different investors. Now these are the different characteristics that I was talking about: the time horizon, the return requirement, the risk, the regulatory aspects, the liquidity, the taxes, and in the end we are going to come out with a very important concepts of investment policy statement. Okay, so I might refer to that as IPS. Moving to the first substance, or should I say the introduction part of it. Now it's very generally written slide, which basically talks about that there are different type of people. So the focus is on the different part of it. It says that there are different types of people out there in the market or in the capital market with different needs and preferences. Okay, we are going to talk about each need and preference in detail later, and it gives an example which says that an elderly person, okay, let us say 60 years old, want a stable income giving security. So one of the needs is security. So an elderly person is going to crave more for a security than for return. So your security and return are two broad needs of the investor, and on this slide we are just trying to highlight that a particular investor with a particular profile will have a peculiar combination of different needs, while a younger investor would prefer to have a very high return, even though it might bring a little bit of risk with it. So to summarize, it says that a different kind of investor will have different combinations of different preferences on the basis of different characteristics like the time, the risk, the tax benefit, etc., etc. And therefore it is extremely critical to understand these factors before deciding on which type of investment methodology or which type of investment instrument is good or bad for each of these. Very critical. Let's start by categorizing the investor community, and I'm going to do that first by the plurality of it. So it can either be an individual investor or it can be an institutional investor. Broadly there are 7 to 8 categories, out of which 7 are already listed here, and within the individual there are 3 broad categories. Now obviously retail, high net worth and ultra high net worth, as the name suggests, is bifurcated on the basis of the net worth, or should I say the pockets of the investor. So before kind of jumping on to the institutional ones, let's look at the individual investors, wherein we say that a retail investor is a normal investor, is an investor which is, let us say, obviously it's illustrative, let us say is a salaried guy, is like a salary school teacher who is able to save let us say $2,000 per month, which is disposable. Now this school teacher, which looks like a conservative profession, is pretty aggressive and therefore can, or should I say, want to invest this money into the capital market. Now this school teacher doesn't have very deep pockets, it doesn't have a lot of capability to take risk, etc., etc. So the point is, a retail investor is going to be the one which will trade in relatively smaller quantities for their personal account. The school teacher, whatever he's going to do, is going to be for her own family. The second category, after the first, the second category is HNIs, high net worth individuals, which refers to, let us say, should I say, CEO of a multinational company, or, let us say, should I say, a promoter of $100 billion company. Now, that particular guy will have a lot of money at his disposal, typically in excess of 1 million available for investing. So, the difference between a school teacher and HNI is going to be that a school teacher is going to do only on his personal account, which is very, very smaller in size. Okay, a school teacher might not have the capability to hire an individual, separate, customized investment expert, whereas an HNI has got adequate wealth and they generally hire advisors to help them with their tax and investment planning. The third category is the ultra HNIs and family offices, which are like, typically association of persons, or, should I say, a joint family which is, running a, let me take example of Suzuki, for example. Now, Suzuki family is running Suzuki Motor Company, Japan, and has been over the last, perhaps 30 years, been able to generate a lot of funds. The point is that Mr. Osamu Suzuki, who is like the chairman of the group right now, will have his own personal surplus also. So I'm not here talking about SMC. SMC will become one of the institutional investor, but here I'm talking about the individual. So the focus is on Osamu Suzuki, who is in person. He is actually an ultra HNI. Okay, the individuals with large quantity of money. The question is, how large is a matter of, discretion and a little subjective in nature. They generally employ professionals to manage their investments. So, quite like HNIs, while HNI will not get into the investments into too much detail, the ultra HNI is really, neck deep into the business of investment, because by and large, their main profession becomes investment. They often form a private company known as a family office, which manages the family's finances. It provides additional services such as tax planning, accounting, payrolls, etc. So the point is, the family office becomes like a one-stop shop solution for all their needs. Okay, so these three broadly are different types of individual investors: the retail HNIs and ultra HNIs. Moving on to little bit detail of it. Since the services provided by the financial services industry, the services provided by those people differ by the type of individual investor, and pretty obviously so, because a regular school teacher, let us say a retail investor, will not need as much detail or as much assistance, because the stakes involved are not as much compared to an ultra HNI. The individual investor also differ in information and knowledge, obviously, because a school teacher will be busy in his or her own daily course. He or she will not have a lot of time to look at the financial newspapers. So therefore, their understanding and appreciation of the capital market is at a different level. Generally, investors are believed to have limited knowledge, and obviously that is the reason why they are going to look at Claritas certificate or CFA or CFPs to manage their funds. Okay, there are a lot of government regulations which try and protect these investors. Now, after the individual investors, we are moving to the second broad category of institutional investors, which is further divided into 6 parts here, which is the pension funds, the insurance companies, the investment companies, the foundations. We are going to define and talk about each of these, the government himself, and the individual company. So what I was talking about Osamu Suzuki, if his company Suzuki Motor Corporation wants to invest any amount in the capital market, then you are covered here. But Mr. Osamu Suzuki gets covered as ultra HNI. Okay, it says that the companies, foundations, and different large investors have got a lot of money to invest, obviously, to make more returns, park surplus funds for securities, etc. There are some organizations like investment companies, banks, which also provides financial services to their clients. So these companies also need a lot of financial information and the knowledge for it. These investors typically have got large pool of money. So the key differentiating point of an institutional investor versus the individual investor obviously is, one, the legal form of it, and second, the size of the pool of the money. No matter how large is Ultra HNI, at the end of the day, it's still an individual. So the point here we are driving home is that your institutional investors will always have a lot larger amount of pool of money to be managed. Let's talk a bit more about each of these institutional investors. Now, not only from an exam standpoint, but also from a general understanding point, these institutional investors onto this slide here are very, very critical, because, I may not be wrong if the viewer of this session may be one of these. Let's say you might be a foundation, you might be, some of the officers in the government, you might be one of the multinational companies who, in order to gain a little bit more understanding about the investment market, is planning to do this course. So I am sure that your understanding, if let's say you are already working with an insurance company, is going to be much more than talked about by these slides. The intent of these slides going forward is to look at some of the macro information about each of these, rather than getting on to the details of each and every characteristics of each one. Okay, so let's first talk about the pension funds. Pension per se, is the amount of payment that needs to be paid to the employee by the company. What is critical is after retirement. Okay, so before retirement, what an employee gets is known as salary or compensation, and after retirement, what he gets is known as pension. Now, investors, who is the participant of the plan, or the workers, put in a lot of their money as a safe haven in the pension fund in order to earn some sort of income. The pension funds, which is basically a large amount of pool which is constituting the money from different types of employees. So I'm talking about an investor known as a pension fund, which in turn has taken money from different employees. This is one of the institutional investors. So the pension funds pool together a large amount of money from these individual workers and manage it on behalf of them to provide the benefits during retirement or sometimes after that. The funds are sometimes sponsored and supported by the companies or the government, which are known as pension sponsors. We are going to do a little bit more detail on that sponsorship part. Since you can see that the amount of funds which are required to be disbursed from this piggy bank sort of thing is to be given at the time of retirement, which is perhaps close to 60 to 65 years depending on different countries and industry. This is not really the age to take risks. So the point is, the pension funds typically invest money only into very safe havens. Not to say that they don't invest in securities like equity, but the point is the proportion which they invest in equity is generally a little less compared to an aggressive investor. And therefore, the approval of the sponsor is extremely important, because safety is something which is of prime importance. Broadly, there are two types of pension fund: defined benefit plan and defined contribution plan. Let us explain what you mean by defined contribution plan first. What you need to understand is there are two parties to it. One is the company and the other one is the employee. Now, in a defined contribution plan, employee manages the entire fund. Employees decide their contribution to the pension account. The company has nothing much to do with this plan, except the fact that whatever is the mandatory contribution that they need to make to this piggy bank is given by the company every year. So from a company standpoint, once the contribution of each year is given, the job is over. But it is basically the role, the active participation of the employee which ensures that this fund stays lively, this fund earns as much as possible, the money remains safe, etc., etc. So the choice of the investment product is actually with the participant. Let's talk about the defined benefit plan, which is quite opposite of it, where the driving force is the company or the employer. Now here, the sponsors pays a fixed amount every year to the retirement beneficiaries, pretty much like the one which was being paid earlier also. But the point is, who is managing this fund now? Who is taking the responsibility whether the amount of money in this piggy bank is sufficient to retire each employee? If it is the responsibility is taken by the company, then it becomes defined benefit plan. If the responsibility is not taken by the company and it actually is managed by the employees themselves, then it is a defined contribution plan. Now once it is with the company, obviously a company is in a better position to understand different aspects of a capital market, and hence, should I say, not to a great extent though, but still to a little bit extent, the ability to invest into stocks, debt, metals or commodities is a little bit more compared to the defined contribution plan. Now you must be thinking that the size of the pension plan should not be much, because at the end of the day it is only for the workers, that too only at the time of retirement. But let me quote you an example which says that the pension funds are the largest institutional shareholders in the world. The Japanese government pension fund investment managed $1.5 trillion, which is very, very high amount by any standard. Okay, moving to the next type of institutional investor, and I'm going to take two of them here, which is endowment and the foundations. Now they're quite close yet very, very different. Okay, let's talk about the endowments first. Now endowments are basically non-profit organizations, so which is really first characteristic, which is like a university or a hospital or any charitable trust, which really have been opened for a particular purpose. They have to maintain a long-term fund to meet their long-term capital requirements. So it is really like a hospital which has been given some one-time grant by let us say any donor, and in such case, now this money which they have got is not really going to come every year. So this is like a one-time thing. This amount will have to be put to the purpose for which it has been donated, and once that is done, we can say that the endowment purpose is being met. These organizations provide services directly to the client, which is a Harvard management company, for example. Remember, so these are open for a particular purpose. On the other hand, something known as a foundation are the organizations that make grants to other institutions. An example of that, a famous example of that, is Bill and Melinda Gates Foundation, which is the promoters of the Microsoft. Now what is happening is, there is, let's say, an investor who has a lot of money, so he has created a foundation. So he has given his dollars to this foundation, and in turn foundation is going to give grants to different institutions, institution 1, institution 2, on merit basis, looking at the need and requirement of each of these institutions. Obviously these investors could have also directly got in touch with these individual institutions, but the point is, the fact that they have created a foundation tells us that there is a regular dollar flow which is coming up, and they really don't want to get into the act of investment. So the action of investment is really happening here. So therefore this foundation is part of the institutional investor. Had the individual institutes being in touch with these individual investors, like let's say Bill Gates directly, then Bill Gates would have become an ultra HNI, and then we would be falling in a different vertical. Okay, so they do not provide services directly but support organizations. So let us say I3 is doing a lot of work in, let's say, one of the countries in Africa, working on nutrition. Now in such case, these foundations are not going to directly come in contact with this Africa or the people who are being served, whereas on the other hand, this hospital was directly serving to the patients. So one of the major difference between an endowment and foundation is that endowments directly get in touch with the client as in the person who is ultimately benefiting from it, whereas in case of a foundation, you really don't get into in contact with the person who is ultimately benefiting from it. Obviously, just a quick point that gifts can be of two nature, which is a perpetual, which is every time, which is coming up, and this term gift, which is like a one-time sort of thing. So endowment and foundations are supported by gifts from donors and invest this money to generate further income.